Hello and welcome to Tri-City Equity Group's presentation of the Cottages at Bell Station, our next Dallas-Fort Worth opportunity. Before we begin, I hit you with this quick disclaimer. Understand that all of the numbers, projections, and returns that we talk about in this are pro forma. They're presented off of the information that was presented to us during our due diligence. We ran our due diligence on this property, came up with our assumptions and our pro forma and our business plan, and arrived at some returns. Markets change, things fluctuate, nothing is guaranteed in real estate. It's a risky endeavor. So understand your own risk profile and where you are as far as financial stability, and understand that, again, this is an investment, things can change, and let's get onto it from there.
All right, so we're going to go around and talk about why we love this deal. And I'm going to go ahead and jump in, start off, man. I'm super excited about this deal. This is a great time to be buying multifamily. We haven't seen discounts like this. We're talking 20 to 40% discounts. The last time we seen this, back in the market cycle, 2009, 2010, this asset was purchased just only 2 years ago for $35 million. With bridge debt that is expiring this year. The sellers right now pretty much can't meet that DSCR, right? We seeing this all around the market right now. Sellers who purchased a few years ago, rates have not came down, making it really hard to refinance. So they're being forced to fire sell these properties, and we getting this property at a discounted amount from just 2 years ago. We're getting a discount of $8 million off the last time this property actually traded. That said, it only took 1 year. It only took 1 year from 2010 for the market to recover last time. And with the current administration in place, we expect interest rates to come down and values to go up. So that's real. I'm really, really super excited about this property. That's make me excited.
Awesome. Thanks, Dee. And this is Jim here, and I'm just going to talk about the area and the location of this. Dee, I'm telling you, I love what you just said there. 23% discount off of where it was. One person's loss is another person's gain, and we're definitely taking advantage of that. We're gaining big time on this one. But from a location standpoint, this is very, very centrally located. There is very little land to build something like this anywhere else in the area. So extremely central location. It's actually really a natural moat, as we say, because there isn't land availability. So if you want to get something this nice, these are like townhouse cottage style apartments. This is like the highest grade of apartment you can really get. You just can't find the land to build anything like this anywhere within probably 10 miles or more. So very, very stable demand, lots of jobs around here. So very excited about that.
Thanks, Jim. For me, what I like is that we're getting B and C class returns on an A class product. For those that have followed Tri-City Equity Group, know that we cut our teeth doing heavy C class value adds over the last 6-7 years. We're talking $1-2 million renovations, full heavy lifts, bringing rents up $400-500 to get those 2x equity multiple exits. Because we're in this trough of the market, we're getting those level of returns, those B and C class level returns on an A class product with virtually no lift. This property is just coming up on its 4th year. We have no big CapEx plan. There's no roofs we got to replace. There's no plumbing we got to replace. There's no windows we got to replace. Those parking lots we got to, dig up and overlay and things like that. Everything is new. It's a nice, light, operational value add. And that's why I love this deal, because I'm asset manager, so it's easier for me.
All right, and I'm going to talk about the taxes. So historically, the bonus depreciation was going to drop to 40% this year, but luckily the One Big Beautiful Bill passed, which meant that 100% bonus depreciation is back, effective January 19th of this year. So it's an excellent time to be purchasing assets like this.
All right. Thank you. Thank you. So I'll go ahead and get started. Again, my name is Duran Bethea, and I'm the Key Principal Acquisition Director for Tri-City. All right. So let's get started. DFW. Why we love it. So again, DFW is number 4 most populated MSA in the USA, with a population of 8 million people, with 750,000 people, new residents this year alone. All right. And why is that? Let's talk about it. We're talking about low cost of living, no state income tax. There are jobs. The national average for unemployment is 4.2%. DFW, 3.3%. We are number one total job growth, number one for property investment and new construction, number one best state for business 17 years in a row. Why is that? We are a business friendly state, number one for women's entrepreneurs, and number two for percent job growth and corporate expansion. Okay, so Fort Worth proper has slightly over 1 million population. When I went out and meet with the Economics Development Office last week, the city leader's goal is to keep that Texas charm with cowboy boots and hats, even as Dallas continues to grow into a big city hustle. And from Cottage at Bell Station, a 3-mile population is 126,000 with about 67,000 employees. The median income is 103,000, while the average household income is 130,000, which is great. We look at two matrices when determining if a deal is worth looking at. And it's real simple for us. Is the population growing? And is the median income greater than $80,000 or more? This deal exceeds our expectation when looking at those matrices. This is a no-brainer. We look at deals all day, every day. And there's a lot of great deals coming to market. DFW is more than just a business. It's a thriving area. It's got something for everyone. From Fort Worth Stockyards, they attract about 9 million visitors per year going into the Stockyard, making it one of the Texas top tourist destination. We have a ton of foods, museums, professional sports team, entertainment, and just tons of attractions. There you see those nearby attractions right there to the right. So two things I'm going to talk about. Number one, we already know what's going on. Like we know over the years, those of you who have invested with us, and we talked about going a mile wide, going a mile deep, and we've been focusing going a mile deep here in DFW. And the reason because we know when jobs come, people come. We see what's happening in the U.S. We see tons of jobs are relocating from states like New York and California, and they're bringing the jobs with them. When jobs come, people come. There's two things I'm going to highlight because we have tons of jobs here. Like I said, the unemployment is 3.3, but let me give you two highlights. Number one, this property is only a block away from Bell Helicopter. Bell Helicopter is their corporate headquarters employs about 3,500 employees. With that being said, they just got awarded a new contract from the government to build the new Black Hawk helicopter. So a lot of people are excited about that. It's going to create even more jobs too as well. And we have your one and only Lockheed Martin. They there too as well. They have about 18,000 employees. If you're in Fort Worth and you're just driving around these back roads and industrial, you'll see Lockheed like all over the place. So that's really good. But with that said, we also have American Airlines headquarters there with 12,000 employees. So, ton of jobs. Again, great state. This is what we look for. And looking at the map here, as you see some of these top S&P 500 companies, these big blue chip companies, they are here, Texas Instrument and all this. This is when I look at Texas and I look where would be places that you should invest your money. You want to be around just diverse, not like what's happening out there in Austin. You got really tech heavy. Houston is oil and energy. But when you look at the DFW, it's just a mixture of different companies. And this is what we look for when we are investing, when we are putting investors' money into a well-diverse system like here in DFW. All right, so as you see, the Cottages at Bell Station is located about 16 minutes from DFW, 15 minutes from downtown Fort Worth, and 30 minutes from downtown Dallas. With that being said, we have Black Sands, which is our vertical integration company. I know Vince's going to hit a little bit about that, but you'll see at the bottom, we have quite a few apartments south of this. Our goal a couple of years ago when we entered the market was to really focus and continue to go south, and everything in the south, we talking about a 20% population growth. One of the reasons I love investing in Dallas, I can close my eyes and put my finger on the map here, and anywhere my finger land, there's going to be a population growth. All right, so we check that box across the whole DFW area, and College Station is, as you see, we go north right over to Richland Hills, which is a very, very great neighborhood. Tons of like high net worth individuals, and this property sits next to this. So again, that's what I have for my analysis for the market.
All right, Duke Ong here. I'm going to go over the investment overview. So first on this deal, we are offering 5 different classes to suit your needs. So first, the A1 class is going to have an 8% preferred return. So that's just straight 8%. There's no split of the remaining profits. A2 class is no pref, but 70% of remaining profits. So 70-30 LPGP split. A3 is going to have a $500,000 minimum investment, and that's going to have a 5% preferred return with a 70-30 split. And then A4 has a $1 million minimum investment, and that's 5% pref with an 80-20 LPGP split. And lastly, we're introducing a new class, A5, for tax-deferred accounts only. So that's self-directed IRAs and so forth. And that's going to have a 1% preferred return with 70% of the profit split. As for sponsor fees, there's an acquisition fee of 3% and asset management fee of 2% of revenue. And we're not charging any refinance or disposition fees. The property itself consists of 140 units, 8 studios, 88 one-beds, 32 two-beds, and 12 three-beds. And it was built in 2021. As for the equity raise, the target total equity is $12.1 million. And A1, A2, and A5 investors have a $50,000 minimum investment. A3 is $500,000 minimum, and A4 is $1 million minimum. We have this under contract at $26.9 million, so 23% below the last time it traded. And we're budgeting about $832,000 for capital expenditures and working capital reserves. The debt terms that we are about to lock in is 63.6% loan to value at about a 5.38% fixed rate. And of course, there's value add potential through better operations and raising rents, about 10 to 16% to market rates. And cost seg study. So I'm going to mention this in more detail later, but because of the 100% bonus depreciation for 2025, we're looking at a substantial passive loss for passive investors in year 1. So the capital stack is going to consist of the senior debt at that 63.6% loan to value, and then the A1 preferred equity, and then the common equity of A2, A3, A4, and A5, and then the GP co-invest. And we always invest at least 10%, but on this deal, I believe it's going to be a lot more than 10%. The structure on the legal side is TEG Bell LLC will own the property, and that consists of the individual investors at 70% ownership, and the management company, TEG Bell Management, 30%, which is the general partners. As for the waterfall, the cash flow, first we're going to distribute the 8% preferred return to our A1 investors. And then it's going to be the other tiers of preferred return for A3, A4, and A5 at 5% for the A3 and A4, and 1% for the A5. And then the profit split of 70-30 for A2, A3, and A5 investors, and 80-20 for A4 investors. And it's a similar waterfall for the refinance and the sale.
All right. Thanks, Duke. Now I'm going to tell you how we're going to get there. Our philosophy is going to be the buy right, finance right, and manage right. That's how we build our business plans. So in our acquisition phase, as Duke and Jim mentioned early on, that we are buying this property right. So 23% discount off of the last time this property traded, 36% below replacement costs for this deal. As D was talking about location, this is going to be in the HEB submarket, one of the top 10 schools in DFW school districts, the ISDs there. So very sought after area, and obviously the economic climate there with the HEB, Lockheed, and things like that. Raytheon is all right in that area. So we are making sure we are buying it right. And when we get into the finance right, as Duke mentioned just a second ago, we're going in with agency debt, 63% LTV, 3 years interest only, 5-year fixed rate on a 30-year AM with a full 3 months of reserves and at closing on top of our CapEx budget. We do this, it requires more of a raise, but when we finance right, what that does is one, it lets us sleep better at night because our break-even occupancy is so low. Our DSCR is so high at closing. We have such amount of cushion for us to do operations. Any kind of market fluctuations that happen, we can eat a lot more of those market fluctuations where a lot of our competitors can't. That's why we're getting this deal in to begin with. And we're seeing these, as Dee said, all the time. People high leverage, bridge loans, floating rates, things like that. We don't do that in Tri-City. We do long-term, fixed rate, low leverage debt. That's how we can weather the storm. That's how our investors have that risk mitigation, and we can make it through the other side no matter what the market's doing. Okay. So that's buy right and the finance right. Now we get into the manage right. So the manage right, I'll go over a little bit better on the next slide, but this is not a heavy lift like we're normally used to. The last deal we did was an A-class light value add. This is going to be an A-class light value add. We're only $100 under market rate rents. Jim later on is going to show you those rent comps, but we're only $100 off market rate rents, and we have like 16 months to get there. That's our pro forma. So we don't have a huge lift. $100 and loss of lease over a 16-month period, it's a cakewalk. Big part of this is going to be the operational efficiency and taking advantage of their inefficiencies that they have in things like the RUBS, the ratio utility billing systems, the billing back for utilities, capturing those other income opportunities on the cable, rent, trash valet, parking, pets, cam fees, things like that. Maybe we're exploring EVs. They are doing a very poor job in maximizing what they can pull in for other income. And they're kind of just throwing stuff at a wall, kind of managing some stuff, not really being efficient about it. We're good at optimizing for other income. So that's the big value add play here, is burning off that $100 loss of lease over about a year and a half. So 2 generations of lease renewals, and restructuring that other income, those RUBs, to make sure we can capture from 70% to 90% of those expenses. Okay, so not a big lift at all in order to achieve our pro forma. Then we get into optimize and harvest. This is phase 3. This is after we stabilize the rent roll and the new tenant base there. So we're talking years 3, 4, 5. We start seasoning that rent roll. At year 3 on all my business plans, I start talking with the brokers again and feeling out where the market climate is. And we call open up a file. So we open up a file with the brokers. We start sending them rent rolls and T12s regularly about year 3. And they start getting an eye on where the market is, where our value is. And then so we can start timing a good place to exit that maximizes our IRR for the investors. So from year 3, 4, and 5, every quarter, we're meeting with those brokers, updating financials to try to maximize the IRR. And obviously, we're meeting weekly with the property managers to make sure we're executing according to the business plan as well. So I can show you the next couple slides, break it down a little bit more for those visual people. Okay. So as Duke mentioned, we have the opportunity announcement, subscriptions open about 8/18. Then we go into the target close of October 2nd. We do have a 30-day extension built into this, so we may take advantage of that. We may not, depends on usually where financing is at that point. But so October 2nd is our target close right now. Phase 1 of our business plan is always going to be assess and baseline operations. We're going to go in with our owner-affiliated property management company. We are vertically integrated here at Tri-City Equity Group now, meaning we do property management in-house. We do all the light construction in-house, unit turns, things like that in-house. And that gives us a tremendous amount of speed and agility and efficiency when we're doing, our business plans, because one, we have skin in the game. If you've dealt with third-party property managers before, they might be good, but it's not their asset. Having that owner mentality on a third party is going to be very, very hard. We own Black Sand Property Management, all the employees, there are employees, we execute on that side. So phase 1, months 0 to 3 is going to be assess and baseline operations, implement Black Sand Property Management systems, and we do a full review of the current resident base and the vendors. That's we sit back and kind of see how the residents are, which ones pay on time, which ones are causing trouble, which ones we want to renew, which ones we don't want to renew or evict. That takes a little bit of time to kind of feel out who's living in these apartments. And then also the vendor review. We go through every single vendor and contractor and see if we can get those prices down. A lot of times, if you've been in this game long enough, you've heard the term vendor creep or contractor creep. where the prices start creeping up over time, a little bit at a time. So the owners don't realize it until they're 10, 20, 25% over market for their services. So we bring that back down to market after we do that assessment. Then we go into phase 2, and that brings out the end of year 1. We'll go through the Gen 1 of the lease targets. So push the rents up to the Gen 1 targets, Generation 1 targets. We start implementing that new RUB strategy that we talked about. We execute any CapEx we find. At this property, it's very little, like we talked about. We implement our amenity upgrades, and we work on stabilizing at the end of phase 2, at the end of the first year. As we go into phase 3, now we're going to get into those second round of those leases coming around for the second time. We burn off the rest of the loss to lease, meaning we're bringing all those rents all the way up to market on that second hit. We're going to start fighting property taxes. We do that every year on every property in Texas, is we fight the property taxes. And then we start stabilizing and seasoning that rent roll, getting that NOI nice and smooth. So we get a good looking T12, and then we start positioning for that exit year 3, 4, 5, where we start talking with brokers and timing that market. Some of the box in the bottom is how we do this. Again, we use AI automation, all the new things that come out that actually work. We're probably doing it. We do weekly calls. We do traction. For those that have heard of traction, EOS, we do traction EOS in our systems, weekly calls. All of our KPIs are managed across the entire portfolio down there in Texas. We're vertically integrated. We talked about that through Black Sand Property Management, multi-domain marketing strategy. We are very quick to assess the efficiency of our marketing and our ROAS, our return on advertising. And we are constantly changing up vendors for marketing to make sure we're getting the best quality leads for these assets. We still use Rently and Tenant Turner. Those are cool things that kind of came out during COVID, where people can do self-showing technology. They can just book their own appointment, go tour their own unit, don't need to talk to anybody. That's great technology we use. We do virtual staging and virtual tours through Matterport scans, drone shots on virtual staging and live staging of units, which is something we do. Another thing that gives us the edge over competition is lowering the barrier to entry. We use systems like Obligo, Rhino, Jetty, and Liberty Rent that lowers the barrier to entry for our residents by giving them security deposit alternatives and also second chance rental assistance, to where if they have a bad mark on their background check that we obviously check, Liberty Rent will give them an insurance policy that we have on the residents, that if they stop paying us, then we get covered for anything that happens. And the same thing, Obligo, Jetty, and Rhino as well. So things that give us an edge over our competition to increase our occupancy and maximize our economic occupancy at our properties. All right. I'm going to briefly go over this because, again, visual learners, I'm a very visual learner here. This is our Gantt chart. This is our part of our execution plan that gets handed off to our property management company. So they are fully aligned in lockstep with us as for Tri-City when we're wearing our Tri-City hats, and we're all rowing in the right direction. They know exactly what the business plan is and when we are going to execute it. So the left side there is the steps of our business plan, and the x-axis down there is the days of our ownership. So you can go down and see all the things we're going to do and when we're going to do it. So we have, this is going to be phase 1, phase 1 and 2, the 0 to 180 days. And then you can click over to the next slide. And this is the long term. This is that phase 3 and exit, where we start talking about stabilizing, getting really good resident relations. We call it close the back door, meaning we want people to love being in our communities, not wanting to leave, recommending their friends and their family. All that's going to be in that phase 3 of our business plan, where we really create a community that's really efficient, really tight operations, and we're stabilizing it as we look for that exits from years 3 to 5. All right, this is a quick site map. You'll see this in the due diligence documents as well, but you can see this is a nice layout of a property. They got multiple gated entries. It's a gate. I don't know if we mentioned that before. This is a gated private entrance property. So they get gates to get in. Nice drive, nice layout, nice community feel. Very unlike your standard apartment complex. This feels like a master plan subdivision, even though it acts and operates like an apartment complex. So we love the layout of this property. All right, CapEx. So you can see the CapEx projects here. It's only $312,000 projected. Very little. This is it's about 1% of the value of the property. So very low compared to what we're buying it for. You can see the items in green Those are just reserves. So of that 312, over half of that is reserves for things that are, that we're projecting to happen, like make readies, that, things that we know it's going to happen, roof repair reserves from, wind damage, things like that, and HVAC reserves from the HVAC systems going out. So those aren't planned and executable CapEx projects. Those are just reserves that I built in as well. So really our CapEx budget's half of the 312 of what we're actually going in and executing. So very, very little that needs to get done at this property. If you're watching this video, on the deck that's accompanying in the cash flow portal, you'll see the link where it says Matterport tour link. We don't need to click it on here because it tends to lag a little bit too much, but you can go through and do a Matterport scan. This will give you a live walkthrough of the quality and the fit and finish of these units to see that these are high quality units, granite countertops, stainless steel appliances, they got everything, okay? But then this is also the type of marketing that gets embedded in our marketing system. So you get to see the quality of the marketing that the prospects are seeing, the leads are getting as they start going to our websites and seeing our ads. They're getting these virtual tours. So definitely take a minute, click on the link, and walk through the Matterport scan to see a little bit of what we do with Black Sand. All right, exit strategies. Again, we always look around that 3-year. Once we start hitting that target NOI, that exit NOI, around year 3, we start talking with brokers, like I mentioned, and then we're also looking for refinance opportunities as well. If we see opportunity, maybe something changes and this market just takes off even more than we had projected, maybe it's a good idea to hold this thing for even longer. So we do look for refinance opportunities where we can do a cash out refinance and maybe hold this thing for another 5 years, 10 years, if the market's looking really, really good. So we look at both options, usually starting around year 3.
All right. So as a result of all of those plans, this is what we're projecting for the financials. So coming in T12, the NOI is roughly about 1.24 million, and we're marking the units up to market rents. And so by year 1, it should be almost 1.7 million. So that's through operational efficiencies and also increased rents. And then over the years, there's going to be rent growth along with expense growth. But the bottom line is we're looking to push it to north of 2 million. So year 5 is going to be around 2.14 million. So what does that mean for you as the passive investor? Well, if you're doing A1, then it's just a straight 8% pref. So on 100,000 sample investment, it's just going to be 8,000 cash on cash return per year. On the A2, we're looking at about 6% cash on cash in year 1, which is going to grow to 8-9% in year 2 and 3. And we have IO for the first 3 years, which is going to enhance the cash flow. Year 4, the IO burns off. So that's why you see a slight dip to about 7.5 to 8%. And then if we exit in year 5, then you're looking at a total return of about 99%. So 1.99x equity multiple over the 5 years. So roughly 20% average annual return. Now, for the risk analysis, because it's low leverage, we're looking at a pretty low minimum DSCR to break even. So in the 81 for minimum DSCR and 74% for break even occupancy right off the gate. And then as we improve operational efficiencies and increase rents, we should be looking at numbers in the 60s by year 1 and year 2. On the exits, the sensitivity analysis compares the exit cap rate to the hold period. So we're projecting a 5.2% exit cap rate, which is going to result in roughly 17.5% IRR if we exit in 5 years. But even if the cap rate were to expand to almost 6%, you're still looking at a roughly 13.7% IRR. And even if we had to hold it for longer, say 10 years, it's still 12, 13%. So it has a lot of buffer for any kind of operational shocks. And then on to the tax benefits. So we did a preliminary estimate for the cost segregation study, and it's looking to be about a $7 million estimated accelerated depreciation in year 1. And because the LPs share 70% of that, it results to almost 5 million. So what does that look like for a $100,000 LP investment? It's going to be about over 40,000 in year 1 depreciation pass through, which you can then use against any passive income. So all the cash flow that you'd be getting is essentially tax-free, and any additional depreciation can then be carried forward for, either other passive income that you have or when we exit to offset the gains. And of course, if you're a real estate professional, for tax purposes, you could also use the passive losses against your active income. Now, as far as our track record, we have done 8 full cycle exits. Our average hold time is 2.65 years. Our average equity multiple is 1.86, which is an 86% total return over that 2.65 years. And so that works out to an average of 33% average annual return and almost 33% internal rate of return as well.
I did want to jump in here real quick about the Tri-City track record. This is our 16th deal as a GP team under the formed Tri-City Equity Group. We have over 50 years of experience on this call alone of real estate investing. This is our 8th deal in the DFW market that we are purchasing. So we are not new to DFW and we're not new to multifamily at all. And then this would be our 6th deal under our newest formed company, the Black Sand Property Management Company. So again, a recap, 16th deal as a GP team, 8th deal in Dallas-Fort Worth, and 6th deal under our vertically integration enterprise under Tri-City and Black Sand combined.
All right. So as far as the investor experience, you would be using our investor portal, cash flow portal. So first you would register under there if you don't already have an account, and you reserve your shares. So again, $50,000 minimum for the A2 and A5, and $500,000 for A3, and $1 million minimum for A4. Then you would create your investor account, enter your banking information, sign a subscription agreement, and then fund either through wire or ACH. And once we start sending out distributions, that would also be through ACH. As far as reporting, we do monthly webinar updates for the first year of the project, and we send out detailed financial reports every quarter. And tax form K1s will be sent by March 31st for the prior year.
Okay, and Jim Bisley back. Thanks, Duke. Really appreciate that. Lots of information thrown at you in a small period of time. But I think the important things to know is that this is a great opportunity. We are buying this property right on the front end. This map right here shows you rent comps. And when you're looking at these rent comps, the area that we're in with the cottages is a fantastic area. When you look at all the other little apartments that we've got written around here, this is a cottage style apartment, kind of almost like a townhouse style apartment. These other ones have more expensive rents, generally speaking, and they're not nearly as nice, in my opinion. So I think this is the cream of the crop property that you can get. And when you look right around here on the map, you can kind of see that we're under market rents. And what everybody alluded to is over time, we're going to be able to mark up the rents, which I think is really exciting. Something that caught my eye right when I went in there was that the current management company was offering 6 weeks of free rent right off the bat. I don't think that's necessary at all. And we're going to make that up very quickly in the beginning. So under market rents that we're going to get caught up on, not giving away massive discounts. So this is all buying a property right and getting it up to market value. Huge advantages here. Next slide. And sales comps, you can kind of see right around here, different properties that have sold. And the same thing, if you look at those and you look at what we're talking about, cottage style at Bell Station, almost like a townhouse style there. The other ones are, they're nice apartments. Don't get me wrong. These are nice apartments. They're in nice areas, but we're buying this property right at 190 a square foot, excuse me, 192 per unit. Very, very low for what this property is truly worth. They also told you, everybody's mentioned that it was $8 million more 2 years ago when this investor took it over. And the advantage that we've got here is we're buying this property right. They got stuck in a bridge loan. They had to get out, and we're taking advantage of that and coming in and buying these right. So great purchase price for an extremely high quality product.
All right. So now we're onto the Q&A section. So why do you think this is a good investment for your portfolio?
Well, for me personally, there's a lot of reasons. The first thing I would say is that I've been doing opportunities like this with you guys for a long time, and I appreciate you bringing me in. I'm very blessed and humble to be surrounded by incredible business entrepreneurs, but not just that, but just great people. I trust you guys with my money. I trust you guys with my life. Let's face it. So I really feel like this is the right group. Trust, transparency. In 9 deals, coming up on 10 deals in multifamily. Not only have I never lost money, but we're averaging 33% rate of return and the depreciation. I'm not smart enough to find these deals on my own. These guys are scouring Dallas, Fort Worth. They find the right opportunity, the right deal. We buy it right. Also, property management standpoint, we now have Black Sand Property Management. We're managing our own deals. When you look at that, and you look at many people who don't really care about your property as a property manager, they're getting like an 80% occupancy. We're averaging somewhere around a 92. Some properties we have are like a 95% occupancy. So there's just so many dynamics that make this a great investment that I can't think of better partners to have and better investments to put in at this time.
All right. Thanks, Jim. Have we ever lost capital or issued any capital calls?
No, we haven't. In 16 deals or 15, this would be our 16th deals, Tri-City. We've never done a capital call from our investors, and we have never exited, lost money for our investors on exit.
All right. And what makes us different?
Thanks, Duke. One thing that I like that I've observed from us being Tri-City Equity Group is the experience that we gained in the military. Me and John, who you'll meet here in a second from Black Sand, we'd have 16 years. D and his team, he's got over 20 years retired Army. So that strategic thinking and then actually turning those strategic plans into execution and actually executing on those efficiently is something that I think that we do better than most groups out there.
All right. So why is now a good time to invest in DFW?
All right, I'll jump in now for that one. Hey, listen, without a doubt, DFW is the top one, number two MSAs in the United States to invest in. And like I mentioned, when you're looking at where jobs are going and people are moving every day, that's where we want to be. And so it's just so grateful for us too as well, because when we first went out here and we was trying to choose a market several years ago, we was almost about to land again out in Austin, somewhere that what we're seeing currently right now. We're seeing 2-3 months of free rent. We seeing the rents are being just reduced, and we looking across our portfolio across Black Sands. We are giving some small concessions, but there's no concessions that we are giving out like other places across the globe. When you're looking at places like the other places on the East Coast or, out in California, things like that. So I think DFW is definitely a safe bet to place your hard earned working capital and not just place it in DFW, but being able to place it with us where we are vertically integrated with Black Sands Property Management, like what Vince had mentioned earlier. And it's just a great place to be. It's going to continue to grow. I believe once the interest rates drop, we're going to see values is just going to shoot up. We're going to see more jobs that are in the pipelines and corporate companies in the pipeline that is already in talks with moving to Texas, and DFW being one of those. We're going to see that continue to come. So I think, again, DFW, without a doubt, we chose the right market. We are blessed because we see and we have friends, we have other investors that are out there that are doing capital calls, that are, having to give their property back to the lender. And we just in a great position. And we are proud, like Jim said, we never ever had to go back to ask investors capital. We never been late on a mortgage, and we never lost investors' money. And that's when and being in a great market like DFW, that's where we like it.
All right, so now we'll go over our individual bios. So my name is Duke. I serve as the Director of Investor Relations and a CFO for Tri-City Equity Group. And I'm also the principal broker of a residential real estate brokerage on Oahu, Blueprint Real Estate Advisors.
All right, I'm Vince Gethings, Asset Manager and Operations for Tri-City Equity Group. I build a lot of the business plan and execution plans and strategies, hand over to Black Sand for them to execute. I also do a lot of the KPI tracking for the Tri-City Equity Group as well to make sure that we are on track in fulfilling our business plans. Outside of that, I own and run Wheelbarrow Profits, investment community and a couple other small home service companies as well in Michigan. To my right here on the slide is John Harris. I mentioned him earlier. He's the president of Black Sand Property Management. He has extensive experience. He's been with us for the last 5 or 6 deals for Tri-City. And then when we stood up Black Sand, we moved him over to be the president of that. He's a senior leader in the military, so he is very accustomed to being in senior leadership roles. So that is his role on the team. Moving down is Steve Buros. He's been with us since the beginning. He leads the insurance negotiations for all of our properties, which doesn't sound like a big role, but believe me, it is a huge role. This is something we have to do every single year on every deal, is go out and find the best insurance rates and negotiate and figure out how we can stay protected, but fight back the constant insurance rate hikes.
All right, again, I'm Duran Bethea. I'm the key principal, so I get to go, sign the debt, and also the acquisition director. Got tons of relationship. I'm the one to bring the deals to the table, to the team, building relationships. Also, the CEO of Bands Brothers Investment Group, which we have just a different bunch of franchises and businesses from all across the different states in the U.S. All right. And you have Bob Fosen. He helped lead the acquisition. So he's actually the one that's, going through the deals. Every week we send anywhere from, 5 to 10, 15 deals, sometimes some weeks. He's also talking and combing through those deals, bringing me those deals for my review once those check our box. But yeah, that's Bob. He's our acquisition person.
All right. Thanks, Dee. And I'm Jim Bisley. I'm the key principal here. And what I've done my whole life is I love real estate, even though I'm an engineer by trade. So back in 1999, I started a vacation rental company in Park City, Utah. We expanded to 9 locations across the United States and recently partnered with a group called Away Day. So we're now the largest vacation rental manager in North America with $12 billion worth of assets under management. This is my 9th, and this will be my 10th deal with this group right now in multifamily, and also do Treasure Studios with Dee as well. So a lot of great synergy between all of us here, and I'm very happy and humbled to be part of this group.
All right, this concludes our presentation for the cottages at Bell Station. If you like what you've heard, or maybe you want to get more information, please click to register, to go to cash flow portal, to register or look at the due diligence documents in the deal room there. Or if you have any questions and want to reach out, you can reach out to any of us. See our emails on there. You probably have our personal emails as well, and reach out, ask your questions. We'll love to talk through the deal, talk shop, and get you comfortable with this investment, see if it's right for you and your portfolio at this time. That is all we have, and thank you for your time.
Thanks for coming.
Thanks.
Appreciate it.